All right, welcome everybody to the fall 2011 chart reading mastery. This is, I don't know how many times we've done this course, quite a few now. And every time we do it, we have professional traders and beginners and everybody else in between. And the course always turns out to be a good course. People seem to get a lot out of it, and I always get a lot of good compliments about it. We've had some constructive criticism, I guess, you could say, in the past, and it's caused me to change the course around. So I would encourage you as we go along, if there are things that you can offer that are constructive for us to change for future classes, that would be great, because we intend to continue to do this because it's such a good set of instructions in learning how to read the market by its own action and just reading the chart pretty much without indicators, just by price bars and volume. And I'll just do this one time. It's the standard U.S. government disclaimer requirements that what we show here is educational in nature. We can't be responsible. I can't be responsible for your trading. And what we show you is very good stuff, but it doesn't necessarily mean that you can reproduce it. As always, you're encouraged to consult a certified financial advisor before making any investment or trading decisions. Also, I'll go over this just the first night, and then we won't do this again, although you'll see it on all the slides. This is copyright protected material. It's for your use, and of course if you have a spouse or a brother or a sister, that's fine. But other than that, please don't reproduce it, and don't share it on a blog or a file sharing site or internet sites or anything like that. And that includes the recorded video, the handouts, the slides for the lecture, and all of that sort of stuff. Unless you want my permission, and then I'd have to look at it to see what it was for. There's been a couple of people who have published articles and they've used charts, and I've given permission for that. But other than that, it is copyright material. So please respect that. Please honor that. And that's as much as we're going to do on the disclaimer and the copyright in the future. So tonight's agenda, I want to just go through a few housekeeping items, and then we're going to talk about market structure. And we're going to talk about how we identify market structure, primarily at this point with trend lines. I'll show you other ways to identify market structure as well. And we'll talk a little bit about why market structure is so important. But let's do the housekeeping items first. All session times are going to be on Wednesday afternoons at 4:30 p.m. Eastern Time. That's this time, of course. It's the same as New York. And we'll run typically at least an hour and a half, and very often you'll see us go to 2 hours. So, grab a drink beforehand and do whatever you need to do, and we'll go for a couple of hours. I usually don't do a break in between because it's I just like to keep going through the material. And all sessions are recorded, so if you happen to miss or if you need to get up and walk away a little bit, that's okay. You can come back and review it later, and the recordings will be available on the course membership page. Helen has that. She'll send you a link to it, I think, but it's right on the website. All you need to do is go to the membership button on the web page, and you'll find it from there. And all recordings will be there, and any downloads that we might put up will be there as well. Now, each week we're going to go through a specific topic, and we're going to build as weeks go on. We start off looking at structure, and then we'll eventually get to trade setups, but there's a process that we're going to go through. And each week, what I'm going to ask you to do is to find in your own markets that you trade examples of what we've been talking about. Sometimes I'll have charts prepared for you so that we all can do it. We do that 3 or 4 times through the course. We'll do that tonight with some charts that I'm going to ask you to draw trend lines on and to observe how price acts around those trend lines. But other times it's going to be just your markets that you identify trade setups or examples of principles of market behavior that we'll be talking about. And now let me just say this, that there's no way that you can listen to me throughout the whole 8 weeks and then just go out and trade this as if you were an expert. You must put the time in. You must travel the road. You got to put the mileage in. And these weekly chart assignments or suggested assignments, I mean, they're not, you don't have to do them if you don't want to do them, but I would highly encourage you to do them if you want to get anything out of the course that sticks with you and that you begin to understand. You really do have to put the hard effort in. Nothing good comes easy, and that is especially true in trading. And we'll talk more about this as we go along. All right, contacts. You can contact me directly, and please send your weekly chart assignments to me. And since it's a Wednesday, try to get them in by Sunday night, and that gives me a day or two so that I have a chance to look at them. I'm a pretty busy guy with my own trading and a bunch of other things that we do. So I usually will sit down for a couple of hours and go through the charts and typically offer comments to people about what they submitted, some corrections if need be, and so on and so forth. So send those to me directly at Dr. Gary at TradingPsychologyEdge.com. And everything else, Helen is there. Helen's my business manager and also my wife, and she's great. She handles the whole business side of the website and all the training that we do and the speaking engagements that I do and so on and so forth. So she's excellent, and she'll go the extra mile to help you out. No question about that. So if you have any questions except for technical questions on charts, she's the one to go to. All right. Okay. So just to give you a little bit of an overview about what we're going to be covering over the course of the next 2 months. Oh, I put the wrong one up. I'm sorry here. What did I do? These are wrong dates. All right, hang on just a second. Let me... Oh, that's because I'm using the PDF file. All right, I'll use that quickly. Okay, we'll just use the PDF for this section. I think we'll be okay doing in this. Okay, so there's a reason for that sort of a screw up, but no big deal. So tonight we're going to go over market structure and trend lines. Next week on the 2nd of November, we're going to talk more about market structure. I'm going to talk a little bit both tonight and next week, and really throughout the course, why market structure is so important. It is the key thing to understand, and we'll talk about that. We'll look at market structure next week in terms of waves. We'll begin to talk about how we can begin to see change in trend through things like shortening of the thrust. And then we'll begin to look at price bars. We'll look at shortening of the thrust in price bars and clustering of closes in price bars as well next week. Then we'll start in pretty hot and heavy on the November 9th on reading price bars. We're going to look very carefully at supply and demand, the transfer of risk in the market, which we see all the time. We'll talk about high volume, and we're going to talk about examples of all of that. Continuing on with our principles, we're going to look in the fourth session at the major indications of strength as it appears on the chart. And there are 6 or 7 of them that we want to know and want to be very, very well aware of when they occur. Same thing on the sell side. Well, we're going to have a break over Thanksgiving, and then we'll come back on the 30th for the 5th session, and we're going to talk about the major indications of weakness. Then we're going to start to integrate on the first week of September, the 6th session. We're going to start integrating the price bars, the signs of strength, the signs of weakness. We're going to integrate that with structure. And then we're going to start talking about certain important principles of price behavior that we see over and over and over again. And when we see those, then we want to look at how price bars and structure interact, and we're going to look to find trades in those areas. So you can see that we start off with structure, we begin to talk about price bars, we talk about indications of weakness and strength, and then we start to integrate it all into something that makes sense and that can be traded. And we'll talk about finding trades, and I'm going to give you, I think in this session, probably the most important piece of information that I can give you, which is a template as to where to find trades. Wasn't developed by me, it was developed by my mentor, David Weiss, but it's a great tool, a great model for finding trades. The second to last session on December 14th, we're going to talk a little bit more about price behavior principles, some of the finer points of chart reading. Then we're going to talk about trade setups. I'll detail a couple of trade setups and show you some examples, and show you, most importantly, how to start constructing trade setups from what we've learned. And then we will conclude the course on the 21st of December, just before the Christmas holidays here in the U.S. And we're going to finish up with trade setups. We'll review what we've covered, pick up on any last questions that you might have, and then I'm going to talk about how to get good at this, how to really get good at this, and give you an outline of the next steps that you can take beyond the course. So that's pretty much what we're going to cover, and it's just an outline. You'll be amazed at how much depth we get into as we go along. And of course, all of this is based in Wyckoff, the Wyckoff method, which I've studied quite a bit, both on my own, through the Stock Market Institute, and with David Weiss, doing one-on-one for quite a bit of time as a student of his, and I still am a student of his. Any questions on that before we start to move into structure? And let me know that you're all with me by just, if you don't have any questions, just say no questions, so I know you're here and I didn't lose my group. Okay, good. Everybody can still hear me. All right. So, alive and well. Good, Kevin. Appreciate that. All right, good, everybody. Let's talk a little bit about market structure. Here's a very basic idea of market structure, but we run from areas of accumulation, and accumulation typically happens in 2 ways. One is it's going to occur at the bottom of a trend coming down. So if we've come down for a while, we then go into a sideways, typically a sideways action that can range from, and it happens on all time frames at all times. It can run for maybe 15-20 minutes on a small chart. to, several months, and maybe sometimes even a couple of years of accumulation can take place. And maybe if it's a couple of year period, maybe there isn't accumulation during all that period of time, but there is some effort to maintain a level. We'll see this in a couple of different ways in the course of in the course. We'll talk about accumulation in particular, and hopefully even in the markets as it's occurring too. But you'll see that accumulation area come into play. And that's the main way that accumulation occurs. And then we start to see a markup where demand is overcoming supply. Okay, and we'll look at what the characteristics of that are so that you can see that clearly. And then a lot of times we'll also see some sideways action occur here, maybe not as large as the initial accumulation area, but we'll see that accumulation, or sometimes they call it reaccumulation, but just a large trading range before the market continues on up. And once it reaches a point, and there's no defined point, but once it reaches a point where people begin to sell out and the market starts to stall, we go into another trading range area. A sideways line is another way to think about it. And it's a place where distribution takes effect, where stock or contracts bought down lower are unloaded or distributed up here, and then towards the end of the distribution area, or towards the end of the trading range, we will typically see some short selling come in. And then supply is overwhelming demand at that point, and we would expect the market to start to turn down. And just like with reaccumulation, we might see, Wyckoff actually had a term for this. He didn't have a term for reaccumulation, but he did have a term for resupply, I guess, or redistribution. He called it secondary distribution. So primary distribution would be up here, and then secondary distribution here. But you can think about it as distribution and redistribution if you want. But they're, again, just simple trading range. Very simple way to think about the market, but there are basically four phases: accumulation, markup, distribution, and markdown. And if you look at any chart, you will see it. And let's just take a quick look at, I think I can go back to the... yeah, let's go back now. So now we can go back to this. We can see it on any chart. And here it is a little bit more, with waves drawn in. Again, it's a schematic. But we have this accumulation range, a trading range that comes in at the end of a trade of a down move of some sort. We accumulate. We see a sign of strength coming out of that accumulation. We'll talk about that. We'll see a markup occur where demand is overcoming supply all the way up. But then demand either tires out or hits a wall here, and we start again to see that distribution occur, and then a markdown where supply has overcome demand. Okay, and typically we will see a sign of weakness here. Okay, and we'll talk about this more in terms of principles of price behavior. But any question here on this? And Lars asks, when would questions be appropriate? Questions are most appropriate when you have them. So when you have a question, just ask. And I've got a little chart window here where I see your chat or questions rather, and put them in the question box, and then I'll see them and we'll stop and pause and answer them. Best to do those. But I'm just checking to make sure that this is being recorded. Sorry. Best to ask questions when they come up so we don't miss the opportunity. All right. So you can see here's a chart of Apple off of the NASDAQ exchange. Everybody should be familiar with Apple. If you're not, it's Steve Jobs's. He just died last week, but Steve Jobs's company that produces the great computers and iPhones and iPads and iPods. And you can see on a lot of people own this stock. It's a big, well-traded stock. And you can see that we go into a trading range. We get a little bit of a markdown. Here we stop. We have some accumulation taking place. There's a markup. We go sideways. We mark down. We go sideways in accumulation, and we mark up. Everybody see that? I mean, it can't be much clearer than that. Lars, we'll talk about distribution and accumulation as we go along. I just want to give an overview tonight. I don't want to get into the details of accumulation or distribution, but typically, just to answer your question, you say, how is it with distribution and accumulation? Does it tend to last less or longer? Distribution typically occurs quicker than accumulation. But not always. For example, here we have some accumulation going on, smaller, and it gives a run up. Here we have a larger distribution or a longer period of time of distribution, and that pushes us down. A little bit larger of a markdown than we had as a markup, and that's typical. What we will see is that the longer we're in accumulation or distribution, the bigger the move up or down. Distribution will typically be shorter, but it's not. It's probably a guideline or a rule that will get you in more trouble than it will be of help. Here is IBM on a daily basis. It's a New York Stock Exchange stock. Everybody's probably familiar with that too. It's another well-traded stock. Lots of people own it in their portfolio. Here we have a big period of accumulation in here. It's just a long sideways line. It's not always easy, by the way, to tell when we have accumulation or distribution. I will show you how to tell, but even with that, it's sometimes difficult to tell when it's going to be over and when, to take a trade. Like, you'd have to know to take a trade in here. There's ways to know that, but it's much more risky than once it breaks out and you look for a trade maybe in here somewhere after a sign of strength. In other words, we've broken out up above this resistance, maybe a trade in here, I should say. Once we've seen that sign of strength come in. But again, the concept is this. We have accumulation, a markup. Here's a little bit of reaccumulation and another markup. And here we are in what looks to me to be a little bit of distribution, but maybe not. I forget how that worked out, but it looks like there's some distribution there. Now, it doesn't always act in these little box-like patterns. Here's an example on a weekly basis. This is SHLD stock. Here we have, there's some distribution going on. It's a little bit harder to see. It's not that clean box-like example. We do have a little bit of that up here, and then a sign of weakness, and then we start down again. So it's not always precise, but this is also weakness in its own right, and we'll talk about this as a sign of weakness in here, where distribution occurs, and we'll be able to, you'll see next week we'll start to talk about this, or maybe it's the week after, I forget, but you'll know exactly when this starts to occur, and you'll be able to read it when it occurs. And here's just an example on a 9,000 tick chart in the S&P E-mini. It's equivalent to maybe a 15 to 30 minute chart, depending on the time of day that we're looking at. But there's a tick chart is it's a little bit different than a time-based chart. It plots by activity rather than by by time bars, but it gives you the same kind of look. And you can see again, here we go sideways in a little bit of distribution. We break down from that, and then we start to accumulate, and then we rally up from there. But even on a short intraday time frame, we see that same kind of flow occurring from accumulation and markup to distribution and markdown. All right, so that's the very basics of market structure. But let me ask you a question. Why do you think market structure is so important? We sometimes, the VSA folks, Tom Williams always talks about you have to understand the background. I think about it in terms of market structure. The terms are equivalent, they're synonymous. But why do you think market structure is so important? Let me get your views on that, why you think it's so important. And then I'll give you some insight that few people, I think, ever hear, but it's important to hear and understand. And Walter says to know what kind of trend we're in. That's good. Wyckoff, Walter, used to say the most important thing to know is the trend and of the market, and that's very important. Are we going up or down or sideways? And that's exactly right. It's important to know that. So we want to know that. And Hans says the same thing, what kind of trend we're in. It determines where best to take a trade, Trevor says. That's right. That's also a very good point. Coming a little closer to the mark I'm interested in conveying to you. Kevin says to be able to tell who's in control can be identified by market structure. That's right too. So if we've been in a sideways range and suddenly we're coming down here, we have this big sign of weakness coming down out of this trading range, then we want to look to go short, right? We don't want to be looking to buy. That's exactly right. Because why? Because sellers are in control. And until the buyers come into control, we want to go with the line of least resistance. It's another way of saying we want to go with the trend. Laura says it gives us clues if there's accumulation in the background and demand is in control, or the opposite with distribution. Right, exactly. And we can also see in that regard, if we've gone on a sideways line for a while, either up here and we start to break down, or down here and we start to break up. If it's been, this is an intraday chart over 3 days, so we're likely to go, if we start to break out this day, then we're likely to try to close that firmly, at least on this day and maybe the next day as well. We should see some follow through, in other words, from this. All those are good answers, but let me tell you what I finally learned in all of this that I want to convey to you, and that is that trading is contextual. It's contextual. Let me see if I can spell that for you. Anybody have an idea of what I mean by this? Trading is contextual. What does it mean that a trade is contextual? Well, I spelled it right, I think. Anybody have an idea? Walter says that structure is allowing us to use different time frames. That's true, but that's not quite what I'm looking for. It's based on what's happened recently. Hans says, yeah, close. You guys are good. You guys are really good. What I mean by trading is contextual is this. Let's say we take, let's say we have a trade setup. And the trade setup is, let's use one that's a fairly well-known trade setup. Let's use Linda Ratchke's Holy Grail, okay? And that's, she would have a market, she would plot, and let me just get a different color in here so that we can all be clear about this. So she would have a 20-period exponential moving average, right? Like this. And she would also have an ADX indicator. Skip this thing here, but she would have an ADX. Wells-Wilder's relative strength indicator, okay? Trend strength. And we would have like a scale here, and when the ADX, it might be really low in here, maybe about 10 or 15, and then as that trend gets underway, it starts to rally, starts to climb. When that ADX is climbing and above 30, then you want to take the first pullback here to the 20-period EMA. So that's the criteria for her Holy Grail setup. An ADX greater than 30 and a pullback to the 20 EMA. And you buy that, okay? That's her criteria. Now, there's lots of other trade setups that you can do. You can look at, any trade setup you want to pick. It's the same thing here. If we take this, what she's trying to measure here is a trend by this ADX, right? By this relative strength, it's this trend indicator. And when it rallies up above 30, typically there's a good trend in place. However, if you're not familiar with what the structure is telling you, and you just go in and buy every pullback to the 20 EMA when the ADX is above 30 in whatever market you're trading, and you do that 100 times, you would think that you would probably have a really good, win-loss ratio. Maybe 70 or 75% of those trades would be winners, and maybe 25, 30% would be losers, right? And you'd make money off of that if you followed that to the T. All you did was wait for the ADX to rise above 30, and you bought when price touched the 20-period exponential moving average, okay? Well, let me tell you what actually would happen. You wouldn't get a 70 or a 75% win-loss ratio. At best, you'd get 50%, which is nothing better than random, okay? Why is that? Why is that? Is because you're not taking structure into context. If you're buying every time the ADX rises above 30 and the price touches 20 EMA, it could be, it could be up in here somewhere. This ADX, just this little section in here, the ADX could rise above 30 right here, if this were 30. And we're coming down and price touches the 20 EMA right here. This is our 20-period EMA. We buy that and we get killed, right? We have a stop loss, okay? So the context here is wrong for that trade. The context over here is right, but this is wrong for this trade, okay? Let me do a different pen color. Context here is wrong. Context here is right. Why? Because the structure tells us that we're in an uptrend, okay? Here, the structure tells us that we're just breaking down below a sideways line. We don't want to be taking long positions there, even if the ADX is above 30 and then the price comes back to the 20-period EMA. Okay? So the context is wrong here. Every trading decision that we make is contextual, and the context is always going to be the structure. And so first and foremost, to become a good trader, you must learn how to read structure before anything else. Let me just repeat that. You must learn how to read the structure of a chart before you learn anything else. Okay? No one will ever tell you that, but this is a truth in trading. That just trading a trade setup, you can go to your library and pull down any book and pull out any trade setup. And Linda Ratchke's Holy Grail is a good trade setup. I'm not saying it's a bad one. Even she will say that if you're not following the structure, you're going to at best be a break-even trader, at best, okay? And that's because every trading decision is contextual, and the context is the structure, okay? Everybody get that? Everybody understand that? Everybody hear it? Maybe you won't understand it, but do you hear what I'm trying to convey to you? You must understand the structure. And the way this course is set up, so I want to be as crystal clear as I can be. The way this course is set up, we used to do it differently, by the way. We used to start off with how do we read a price bar, and how do we determine whether whether we should be buying or selling, and whether we've got accumulation or distribution and all that stuff. And then people began to say to me, Gary, can you start with structure first? Because that's always so important. Because I emphasize it all the way through, and I always have. And people said, you should start with structure. And so we did that, and we tested it on a group. They were kind to allow us to test that, or allow me to test that. And the results were very good. People said, yes, this made a whole lot more sense. So you're benefiting from you're standing on the shoulders of some of the folks who came before you and suggested that we up front emphasize this idea of price structure or market structure as being so important, really being all important. You can kind of blindly buy in anywhere in here if you're in an uptrend and you go long, and you're going to be fine. You buy in here, anywhere in here in a downtrend, and you're going to get hurt. So structure is really important, and that's the context. And always try to remember that. So the guiding question would be, what's the context? Yeah, the guiding question is, what's the market structure telling us? And one of the things that I often see is that people will be, when we're reading a chart, I will see people say, well, the last two bars are showing this, and okay, that's fine, but what's the rest of the chart saying? It takes an effort, but our eyes naturally go to the hard right edge of the chart, and we want to see, well, what's going on here. But it's more important to be looking, at the whole chart here, rather than the right edge. I mean, just looking at this chart, just to give you a sense, if we're looking at this chart, and here's where we are on the right edge, I got supply over here. We're coming into a supply area. We've got a trend that's coming up, and up here it's starting to flatten out at supply, okay? And now as we're coming up, these price bars, now I'm looking at the edge here, they're starting to narrow down, and we're not getting the kind of movement like we had here, or we had here, right? Now or here. Now we're starting to see the price stall. But, we don't, so I'm not looking, if I'm long, I'm going to be looking maybe to close that out, unless we, really start driving up above this. But I'm thinking, we could up thrust this and then start coming back down, or just stall in here and go sideways for a while. So why do I want to sit in a trade if I'm long? But all of that comes from being able to read what the structure is telling me here. Okay, not by looking at the last few price bars. Okay, but that's what everybody does, or I shouldn't say everybody. That's what most people do, is that they look at the last few bars. So what I'm going to encourage you to do for the next few weeks is not look at the price bars, at least in this course and when you're doing the homework, but to have a softer focus. Step back a little bit and try to see what's going on overall in this chart. Because once you begin to see what's going on overall, the right edge becomes a lot easier to manage. The right edge becomes a lot easier to understand what's going on. Okay, but going in on the right edge, and even and saying, okay, well, there's a test there, or there's a spring there, or there's a Linda Ratchke Holy Grail, or buy ante or sell ante setup, or whatever, or Alex Elder MACD buy long trade, or whatever trade setup there might be. You at best you're going to be a break-even trader. Okay, at best you're going to be a break-even trader unless you understand structure. And my job, as I see it, is to try to help you be the best trader you can be and be a successful trader. So one of the ways that we identify structure in the market, there's probably 1,000 different ways. You know, Linda in her Holy Grail setup is looking at the ADX to try to help identify a trend, right? You can use indicators, and I don't have anything against indicators except for the most part, except for one or two that I use. And I'll show you what those are as we go along. They're nothing real sophisticated. But except for one or two minor little indicators that I use, the price and the volume are going to tell us most. And the classic approach to reading the chart and to understanding the charts is tried and true, and it's been tested for 80 plus years, and it works very well. So trend lines, we're going to get into those tonight, and I'll show you everything that I know about the Wyckoff approach to plotting trend lines. And it's pretty simple, it's pretty straightforward, but boy, what you can see when you do this is pretty darn amazing. Okay, so trend lines, we're going to talk about horizontal support and resistance as trend lines, my most favorite trend lines, and how to construct them. We're going to talk about simple trend lines, the demand, a diagonal line, in other words, a demand line and a supply line, and I'll explain why I use those terms. We'll look at how to combine those into trend channels. We'll look at something people probably aren't aware of, which is the reverse use of trend lines, a Wyckoff concept. And then we'll look at the confluence of trend lines and how useful that can be. Okay, so let's get into this. Any questions so far on context, market structure, going into trend lines, or anything along the lines here? What's the first sign that structure might change? Walter, that we're going to talk about next week when we talk about waves. We're going to talk about looking at structure and looking at structure. Tonight we're looking at structure from trend lines. Next week we're going to look at it from the perspective of waves in the market, and we're going to look at how to tell when the waves change, how that predicts frequently either a good pullback or a change in trend, and we'll see that. Okay, but good question. How far back should we see the market structure? That's a good question, and there's no absolute answer. Sometimes, as you'll see in some of the charts here, a year or two goes by in a stock, and that trend line will continue to have some effect. In 2009, Goldman Sachs came down to a little bit below $50 a share in its stock when it was up over 250 or 260 at the height of the market in 2007. And it came down to its low in 2009, and that low was a support point 6 years earlier, I think. So, it's hard to say what's the right number of bars that you should put on a chart, or how far back should you go. A lot of it's dependent on what's your time frame. If you're trading for the swings, for a 3 day to 2 or 3 week swing, then 6 months or maybe a year's worth of data is plenty. We'll talk about multiple time frames too and how to use those, and so you don't have to have 1,000 bars on each chart. You can just have a few bars on the smaller time frames. But if you're position trading, then you want more data. If you're trading off of a 5-minute intraday chart, you need a couple of days worth of data. But you certainly want to look at the more significant levels of support and resistance, and we'll talk about those and how those get framed out, starting with this chart right here, in fact. Is structure only evident with price bars? What about candlesticks, Renkos, line breaks, etc.? In the way that I trade, structure is only evident with price bars. Can you use candlesticks? Yes, you can. Can you use Renko charts? I guess you can. I don't really know about them. So things I don't know about, I don't really like to give advice on. I don't think that's a good idea. Point and figure charts I do know quite a bit about, and those are useful as well, though we're not going to get into those in this course. If you want to use candlesticks, you can. The danger with candlesticks, as I see it, as I have experienced it, is that it focuses you on the last couple of candles on the chart, and it's seductive because you see, you know, a spinning top or an evening star or 3 flying crows or whatever the terms are for those candles. And you start taking trades based on that. And that's, as I'm trying to explain to you, that's not a good way to trade. So if you use candlesticks, that's okay. Just integrate them with the structure. That's really important. Okay, good questions. Let's take a look at Goldman here and just talk about how we would want to draw and use horizontal support and resistance lines. And, you know, it's an art. It's not a science. It's really an art. But the more you use them, the more you recognize how much the market respects these and how much the market will trade around them. So, for example, Ronald says, will you be giving an example of multiple time frame analysis later? Yeah, I will, Ronald. I will. So on Goldman, for example, we have a rally up, and then we start to pull back here, and we have a pretty good pullback. So immediately, I'd be drawing a line along the high where we reached, and then as the market begins to rally back up after it's established a low, then I draw in a line below, okay, as a support. So lower A would be a support level, and upper A would be a resistance level. Not much more difficult than that, okay? As we rally up here and we start to come down, I would put a line in here as well, but I didn't. I didn't include it on this chart, but I would have it on there as I'm looking at this market and thinking about a trade and looking for a trade location. But if it never, you know, if I have that line on here, and then after this price action, I would remove it. Okay, I'd erase it from my chart, and that's okay to do. And notice, lower A, we could extend it all the way out, and it never comes into play again. Okay, now I left lower A on just to show you that that's how I would initially frame the this what turns into a trading range out. And just like here, I would put this line in too, but it never comes into play again either, right? So those lines would be taken out, taken off, erased. But I didn't do that with lower A because I wanted you to see that. So anyway, we come to lower A, we rally up, we come to this level, we come back down again. As the market approaches, it respects this line B here. It pulls back and starts to push forward. It drives up through B, and if we extended it over, notice that it comes back down and tests it and pushes back up again, and then comes down one more time, now to lower B. Okay, we rally up. I'd have a line in here too, but then we push up and it's no longer a factor, so those would get erased. So I'm always drawing lines. And eventually we get a set of lines that are working quite well. By the time this rallies up and, you know, we're holding in here, this is a good line, this lower B. And certainly as we drive up here and come back down here in late November, where we started in June, so 5 or 6 months later, this line is now forming support for us. Okay, it was resistance here, and it was resistance here. Once we drove through it, it becomes support. And this is a key characteristic of horizontal trend lines. Once they prove themselves to be resistance, and then we push up above them, and if the market comes back down, they will frequently act as support and are often very good buy points. This happens to be a classic Wyckoff trade setup in a reaccumulation area called a jump across the creek, where the market jumps above the supply, the creek being the supply. And I'll talk more about that a little bit later, and then comes back and tests that again and then rallies up from there. Here we just go into another sideways trading range, but and you can draw that in too. I mean, you can see this would be, maybe line C here and line D, and you can see how it's being respected. Okay. Any questions on that chart? I love horizontal support and resistance lines because I find the horizontal lines to be, I don't know if they're a little stronger than the diagonal, but I like them. I like them best. I think because everybody sees them and they're pretty clear. Okay, so here we are on the 60-minute SPY, an intraday chart. And I'll do this. I'll show different time frames. The previous chart was a daily chart. Here's a 60-minute chart. I'm only trying to do one thing, and that is to emphasize to you that all the things that we cover in this course work equally well on any different time frame. You pick your time frame, and it'll work on that time frame. So here we are. We come down. We have a little bit of a rally. Once we do that, I'll put a line in here. I call it lower A. We dip down underneath, and it pushes back up and drives right up above upper A here. Notice as it comes back, upper A was resistance, just as we saw on the Goldman Sachs chart. And as it comes back down, it serves as support. Okay. We rally up. We come back up into upper prime. We poke above it there and then come back down. I'd put in trend lines here at B and lower B. Lower B never really comes into play again, this whole chart. But I left it in here just to show you that I would put it in, and as it becomes unimportant, then I would take it off the chart. We rally up to C, we poke up above B, and we now establish this level here at C. We come back down, and we're back down at A prime again. I also labeled it a little bit lower at C just in case market did something down there, but it didn't. You could just say A prime would have been fine. We rally back up. C tends to keep us from going higher. It acts as resistance again. We come back down to A prime, and again, A prime was resistance. And now here at these two levels, it's really acting as support, right? We rally up above, we come to D, we come back down again to lower D, which is really kind of the same level as B, right? Again, resistance acting as support here. We see this all the time. We rally back up, D is creating more resistance in here. We come down to this level, push up. I would draw a line in that gets respected over here a little bit later. We come up, we have this level here that we have a small push up above, and upward price gets rejected. We come back down again, and notice we're right back down on this level to D, or what was all the way back over here at B. Right? We're back at support again. These guys was resistance, support, and now support again. Right? We rally back up. And you can see that E is acting as support way over here. All right? Is that fairly clear to people? How these horizontal trend lines work as resistance initially and then turn into support? Very, very important concept. Very useful thing to always keep in mind. The A is important with the last S. Yes, that's right. You're right. That does come across like this. And we'll talk a little bit about this a little bit later, but this is also what we would call an access line, where the market tends to rotate around this area. You can see that it gets stopped here at A. It comes back here a couple of times. We come down again, it bounces off. We come down again, it bounces off. So, you know, the market is trading around this level, this 126 and change level. And that's something, when we see that a lot, we call that an access line. I'll talk a little bit more about that. Why did I name it A prime? Because I don't know. I was just in that mode, I guess. I should have called it B, maybe. But I didn't. Here's the S&Ps on a 60-minute basis on a down move, and very similar. Okay. We're coming down, and we hit A here, we rally back up to upper A, we come back down. This time I called it A prime to the downside. Don't ask me why, I don't know. But A is really kind of serving as support here. We rally back up, we come into resistance. Okay, we come back down to A prime, it's support. We pop back up into B, we come down to lower B, it acts as support over here. We drive back up to B prime. I don't know, I was in some sort of scientific mode, I guess. We come back down, we touch B again, and then we rally up, but we fail to go all the way up to the level of B prime, and then we come down. Notice now that A is acting again here as resistance, and it did over here a little bit too, right? And then B acts as support, lower B, comes down to lower B, back up to A, down to C, back up to B, down through C, back up above to C, into B again, a lot of letters, and so on through the chart. And you can see this is a good example. Let me erase this so we can see clearly. You can see that B is a good example of an access line where the market comes down to it. We come down here a couple of times, another time here. It drives through it, comes back up to it, gets repelled, comes down, drives back up to it, gets repelled again, and now it's finally gone through it. And, you know, I would extend this line out. I'd at least note it, because if it comes back down here, this is, you know, this could be an important part, an important spot. Okay. Oh, you're taking notes. Lars, the prime is just a label. It's nothing more than a label. It's not anything significant. It's just, I could have labeled this instead of A prime, I could have called this B. Okay, and then this would be C, and lower C, and then this would be D, and so on. But I didn't. I was trying to be fancy, I think, at one point, and we're not. And I'm probably now confusing you more than anything else. Okay, but so now we've seen a few horizontal trend lines. What do you notice now? What do you notice? No, it doesn't really mean higher or lower. Lars asks, does prime mean higher or lower? No, it just means A prime is, this is A and this is A prime. We put this little notation here alongside of it, like right here. It's just a way to label something. It's just a name, nothing more. It could be called Z or X. So the market has memory, Chris says. What do you mean it has memory? Yeah, that's what Laura says, language barrier. Yeah, I suspect that it's just a language thing. What do you mean the market has memory, Chris? It's just I know where there's been turning points in the past. Very good, Chris. Think about this for a second. We come down here to A, and we rally back up to upper A, and supply came in. We're in a downtrend, first of all. So supply comes in at A, and we come back down. Don't you think supply has got a good chance of coming back in again here as we reapproach this area, right? Especially if we're in a long downtrend. We've been coming down for a while. I surely would, because for a whole host of reasons. But the structure is saying down, and we want to lean against structure and trade against the edges. For example, here, as we're coming down, what's the definition of a trend, everybody? What's the definition of a downtrend? Tell me what your definition is of a downtrend or an uptrend, either one. Lower lows and lower highs, right? Yeah, lower lows and lower highs. So if we start here at B, and maybe we're thinking, gee, we've been in a downtrend, it's been going on, and now we've made a little higher high and a higher low and a higher high. Maybe we're going to get, oh, it doesn't happen. We actually get a lower low here, and a lower high, and a lower low. Well, if we've now got a downtrend back in place, making new lows on the month or whatever we're doing here, but we've just broken down from an important support point, wouldn't it be nice to know that this level here is, if the market comes back up to this level, it's likely going to be a point where the market... Go get him, Asta. That's my dog, by the way. He's always down here. Isn't it nice to know that that's a point that it's likely that the market will turn, and we can read this. We can read this area in here, and I'll show you how to read that. But first and foremost, the structure is highlighting for us that this is a potential high-value area for us to take a trade in if other things fall into place. Okay? Does that make sense? Kevin, you're laughing at the dog. If you're in a downtrend structure like here, wouldn't you have added 2 trend lines? Oh, you mean diagonal trend lines? We're going to get to them. I haven't gotten to that point yet. We'll get to those. We'll get to those. We're just doing the horizontals here for now. But wouldn't it be nice to know that? And that's why we start to lean against structure. Yep, that's right. It's a good spot to lean against and make a trade. Okay. All right, let's go on here. Asta's guarding everything out there. Here's ConocoPhillips. This is a little more detailed. Now we're looking at horizontal support and resistance along a trend and a trading range. And we can see that the market comes to a level here at A, and we drop down. We go underneath this lower A, and we come back up, and we've come back to the little bit lower high below A here, and the market fails at that point and fails to go higher. That tells us immediately that it's going to probably go down through the low of the last support, because it's going to look for buying down below. It's not finding buying up here, so it's going to go down to, it's going to start selling off until it does find buying. We put in another low here, and we come back down to the low of B, and we dip through it and then start pushing up through above it. We have a little bit of absorption here. We'll talk about that in a future lesson. But where the market just kind of hugs along where supply has been in the past. And then we push up above A. We come back down here and we have two levels of support here. We have a support at C here, lower C, and we also have our line from A. And the market pops up. I love this. Market pops up and then starts to drive up. We get a little bit of difficulty here at upper C where it acts as some resistance again, but we don't go down very far. We go up to D and then lower D and all the way up to F. But look at what happens. Now, this is March, I guess, or end of February, early March, where we put that A in. And look at, we come back to it here in June, again in October, again in, I don't know, December, I guess. Even all the way back here, we're still around that level. It's over a year later where this level is, you know, we can frame all of this out with structure, but this is the large structure. So if we were position traders and we had a monthly chart up, we would see this level A is very significant. Very significant. Okay. Most of us are not big position traders, so we would be looking at you know, shorter swings in the structure. And you can start to see, you can see how the market trades up and down and around those support and resistance points frequently. And you can see here G in the middle is another one of those axis lines. The market comes down through it, tries to go up. It's resistance here. Resistance here. It pushes up. It becomes support here. Holds the market just a little bit, comes down, back down to resistance, resistance, comes down, back up, resistance, right? Resistance, pushes up through it, support, support, down through it, resistance, and resistance. Market's been trading around this. We often see this in the middle of a trading range where there will be an axis line. This is great for a swing or an intraday trader to be able to see this. When we have a larger trading range and we have a good swings in the middle of a trading range, we will frequently see, and this happens again on all time frames, we will frequently see this axis line. And you can start to play with multiple time frames and look on a higher time frame for a large trading range and then drill into a smaller time frame and start to see these axis lines like this. Okay? And you can get some nice little moves off of it. Come on in, pup. Yeah. Okay, some questions here. It's also Gann's 50% line of the whole trading range. That could be, Lars. I'm not a Gann. I'm not familiar with Gann stuff. What I'm trying to show you is that structurally, let me just say a few things about Fibonacci and other things. They're all, you know, you can use them. I'm not saying that they're a bad thing to use, but what I look for is what everybody else can see. In other words, I want areas that are obvious on the chart. So, you know, a support level in an uptrend here, like at E, that's an obvious level for me, right? Certainly A here is an obvious level. I can see it. Everybody else can see it. I want everybody else to see it because then they're going to look, you know, make position, take trade positions there as well if they're a support and resistance trader, and there's a lot of those out there. When it comes to things like Fibonacci numbers or Gann numbers or, you know, I don't know, pick your number, floor traders, pivots, and all of that, you know, they're probably useful, but I don't use them. What I'm looking for is the obvious stuff on the chart, and that's what I find to be most helpful. The only number I tend to use from time to time is a halfway retracement. Wyckoff talked about it, but I don't even really use that all that much. I'll note it if it's there, but I won't note a Fibonacci retracement or a projection or anything like that. I don't bother with that. I've certainly used it in the past, but for my own personal trading, it's like candlesticks. I didn't find that it added anything to this particular method. I'm not saying it's negative or that it necessarily detracts, but what I'm saying is that I haven't found that it adds to it in my trading. All right, and if you do see it a lot, Laura says he sees it a lot, then that's great. Use it if it works for you, and look. Part of the game of becoming a professional trader is to find out what works for you, and then to hone that down, sharpen those skills down to the point where you're really an expert at it. That's the whole idea of being a good, solid trader, is to become expert in a methodology. And if it's Fibonacci, that's great. If it's candlesticks, that's great. If it's Wyckoff, that's great too. And you can take pieces, you're all here to learn how to read the market by its own action. And so if you've been using the Gann 50% number and it's been working for you, I wouldn't give that up. I certainly wouldn't give that up. But all I'm saying is that I can show you what works for me, and it's all based on Wyckoff, and Wyckoff preceded all that other stuff. Maybe not Gann, but didn't use Gann. He wrote about Gann though. He liked Gann. Besides showing the support and resistance level, is there anything else that we can learn from an axis line or an important level? Asks Hans. Only, Hans, that you use them in two ways. I use them as a way, let's say, for example, let's clear some of this out, try to illustrate this. Certainly, if we're coming up to the top of the trading range and we want to make sure each of these levels is going to be important. I'll just put a number on them. Here's level 1 and level 2. So let's say, for example, I buy down here for whatever reason. I buy in here. So I want to see if it, first of all, will get up above H, and it does, right? And I note G, and we're pushing up above G, and does it reach 2? Yes, it does. Does it now reach 1? Yes, it does. So now the target becomes F, right? Each of these levels become a target. So that's one way to use it, aside from leaning against it to take a trade, is if I buy down here, will it get up to here or higher, and will it on the way be able to break through these levels here? Okay. Or if I shorted here, if I went short up here, is it going to come back down to A or H down here? Okay. That's going to be, so you use these levels. If I short at 72, is it coming back down to 58? So I'm using those levels to try to track my trade. Well, I'm making lower lows and lower highs and lower lows and lower highs, and I'm making progress towards this level. Okay, that's one way to use it, other than just support or resistance, where we can place a trade. The other obvious thing is to take a trade off of it. Okay, so those are the two basic ways. One, to use it as a tape reading tool. Are we getting closer or not to the target? And when the target is, this is one of the reasons why I like obvious targets, because everybody can see them, and they're going to drive the market towards those targets more readily than I've seen it, at least on Fibonacci kinds of things. And then the other is we can lean against that support and resistance for a trade. Okay. And it's also, yeah, the bar by bar analysis will help you when we approach those levels, and then we'll start to see, do we want to exit a trade if we're long and approaching resistance, or do we want to get ready to go short, or will it drive up through? Okay, let's talk a little bit about diagonal trend lines. And we'll start with this chart of RIM. Now, notice I have some numbers on the chart here, 1 and 2 and 3 and 4 and 5, right? And I also have a trend line here labeled AA. And that's our demand line. That's our diagonal trend line. Just when we just start out and we've got this low here at 1 and we've got a low at 2 and we start to rally up, I would certainly put a trend line in like this. Okay. Now, once we start to make higher lows and higher highs, I'd probably get rid of that trend line, at least on this time frame, because it's not really helping us anymore. Okay. And likewise, once we make that higher high and we come down to 3 here and we start to rally up, then I would draw a trend line in from 2 to 3. Okay. But now as it comes back from 4 and down to 5, it kind of disturbs that trend line. It doesn't respect that trend line. So I would readjust it. I'd be constantly readjusting it until I got to the point where I had a couple of touches here on this. Okay? When that trend line, when the price starts to respect that trend line pretty well, then I know it's going to be pretty valid until it's broken. Okay? Once I get a couple of touch points, these are touch points, then I can have more confidence in that line. But until that occurs, we may have to adjust it. Okay? Again, there's an art to this. It's not just a science. Now, we call this, sometimes in the Wyckoff literature, you're going to see it, most of the time you'll see it referred to as a support line. I like the term demand line because it's where demand comes in and turns the market back up. We were coming down here, and this was the last point where we had supply before buyers stepped in and rallied the market up. This is where demand came in. And it rallies up, it comes back here, we have a little bit of supply, but buyers step in and drive the market. This is where demand comes in. Likewise here and here. Okay, so that's why we call it the demand line. It's where demand comes in. And in an uptrend, we always draw the demand line first. In a downtrend, we're going to draw the supply line, okay, where supply comes in. But right now we're talking about a demand line. We draw that demand line in first. Okay? And what we're looking for is to find 2 wave lows or 2 swing lows where demand does come in that are, comparable in significance. And that's where we would draw our trend line. Okay? And hopefully that'll become more clear as we go on. Any questions about this diagonal trend line? About how to draw it? We want to draw it off of the 2 first swing lows where demand comes in, where the pullbacks are about comparable, and then we want to adjust it if need be, but look for some touch points, and then we have more confidence in it. Okay, all right, I don't see any questions here. Now, let me go back here a second you notice I have this labeled AA here. This is RIM. And the next chart is also RIM. And what we saw on the first chart was this section here. Okay. AA. And then the market pulled back and broke that trend line, broke AA at 1, and it was no longer a valid trend line. But then it drove up above the last swing high here, up here, and comes back down to 2. And demand comes back in at 2 and drives the market up. So we draw another trend line here, BB. Okay? Demand stopped the market from coming down at 1, and demand stopped the market from coming down at 2. It also stopped the market in that little spot between 1 and 2, but that's not quite a significant swing low. 2 is much more significant than that 1 in between. And there's no calculus that you can do about significance. It's more of an eye kind of a thing. Does it, here we have this length down, that's only a small amount down, and here we have this length down. So this is much more comparable to this. Okay. And so we make a higher high and we come up into this area. Now we draw it off of 1 and 2. Let me erase this so you're seeing this. We draw it off of 1 and 2. We make a higher high, and then we come back to it over here, right? So a trade in here is called for. And this is a nice spot for a trade, and look at what happens. It drives back. It drives on up again. And note that the angle of ascent has changed again. The angle of ascent was here. Now it's steepened a little bit, and now it's steepened even more. So we would draw a third, maybe line CC in here, off of this point and this point, okay? Or try to get it really off, off of this. It gets a little bit thin up there, but we would draw another trend line up there. All right, question here. Could we say that where demand is repeatedly coming in is anchor points? You could if you want to. And when price goes below, it is shakeouts or springs. Well, if it goes below and it continues to go, it's no longer a shakeout or a spring. It's now broken support, right? Springs are not drawn off of diagonal trend lines. Shakeouts, yeah, this would be a shakeout here. I'll go back up to that other chart. So we've got a pretty good trend going on here. It rallies up and then they drive it down on big volume and then close it back up. That's an ordinary shakeout right there. It came back to the trend line and then on up again. That would be more of a shakeout. Okay. A spring is going to be drawn off of a diagonal trend line. I'm sorry, a horizontal trend line. Same thing here. Here's a spring here that initiated this. Okay. We had a downtrend, got oversold in the trend channel. We have a spring. We rally up, test it, and go. We'll get into that. We will get into that. But springs are done off of horizontal. Okay, let's continue then with our diagonal trend line. And now let's talk about a downtrend. We've talked about an uptrend and demand lines. And now let's talk about a down move or downtrending action and supply lines. We draw the supply line, the same way that we draw a demand line, where supply comes into the market. So supply came in here, and it also came in right in here. So we would draw supply line AA along like this. And notice, this goes back, this is a chart from Goldman Sachs in 2002. And this starts in January, and we're down here in August, 8 months later. and this is respecting this supply line. Okay. Now, when we're looking at this kind of a time frame and we have a larger structure in place, we can also have a more a minor structure in place. And you can see that as we're coming down, we can draw this line in here, BB, starting where the supply came in. We fall down, it tries to rally up, but supply comes in earlier than line AA, right? Earlier by meaning it doesn't reach all the way up to here. It comes in here. And it comes in here. So we can draw this line BB off of this point, and it starts to contain it all the way down, okay, until it breaks. It breaks here, and then the market rallies back up to line AA. Okay, see that, everybody? So this is drawn from where the supply comes in. Now, how do we construct trend channels? Fairly simple. In the Wyckoff method, we have line AA, and we take a parallel of that, and we paste that parallel. Most charting packages allow you to do this. If it doesn't, then just draw line AA first across the two supply points, right here, and then grab it with your cursor and bring it down to C, and then redraw a line AA on those two supply points again. So, or you do that, or you just say I need another parallel, or copy the line or whatever and paste it, or drag it down to the low point where demand came in. Okay, so this is our supply line, and we draw the supply line when we're in a downtrend. We draw the supply line first, and then to draw a trend channel, we make a parallel of that, and we put that parallel where demand came in. And so this is our demand line. Okay, and you can see that we have touch points here and here, and yet this would have been drawn anytime after, say, this point when we started turning down. We would have line AA in, and we'd have line CC in, and months later this is respected. Okay, any questions on that and how to draw that? And if we were in an uptrend, if we were making higher highs and higher lows, we draw our demand line in first, where demand came in, take a parallel of that, and put it where supply came in, and that would be our supply line. So in an uptrend, we draw a demand line first. In a downtrend, we draw the supply line first. Make sense? Okay, good. Any questions on that? All right, here's IBM. We have this large down move here, and we find stability. We find support down here at 1, and we start to rally up. We come to 3, and we pull back to 2. So demand came in here at 1, and demand came in here at 2. So we would draw our demand line AA from 1 and 2. And notice way up here, several months later, it respects that level again. Okay. And we would draw a parallel as a supply line and put it in here at 3. Okay. Now, when we're starting out, we see this higher high being made, and then it pulls back, and then it starts to rally up again. I would initially draw that line like this, and it respects it here, but then we don't get very far up above this level, and now we come down, we break this. So this, at this point, this line no longer works for us. Okay, so erase that, and I might try doing something like this, or I might try doing something like this, but eventually we would get to this point here. Okay, and there's also a certain look, this look of symmetry. The more symmetrical or the more pleasing it looks to the eye, the better it is. And what it really is doing is measuring the pullbacks in a trend. And you notice here in the middle of this, we start to we don't come all the way back again to the demand line of AA. We're holding up in here, right? You can take a parallel of AA and put it on this point here, point 4, and this are parallel lines. And you can run another parallel and put it on point 6 up here, the high here, and show the supply line. So you can have that kind of thing going on. And we would do the same thing here and here. Okay, we might use this this line might be EE, but we might have drawn that a long time ago, early on, and then a bigger line here. Okay. We often see this, where the angle of ascent will maintain itself, but it will be at a higher level in the trend channel. Okay, but the same angle of ascent will be the angle of ascent will be the same. It'll maintain itself. So watch for that too. All right. Any questions on that? I'll just pause for a second and see if there are any questions. Okay, not seeing any, I'll continue on. But if you do, go ahead and ask. And we can always go back. There's no difficulty in that. Okay, so here we are on another chart. And we're in an uptrend. We're making pretty good progress going up. And so we can draw a demand line in. We would draw it here and here where demand came in. And it respects it here and respects it here as well. And we would make a parallel of that, right? And this is a nice demand line, so we want to put a supply line in as well. So we make a parallel off of AA and we put it at this point. And we would call that line BB, right? Everybody can see that. But what do you notice here? What do you notice at this point and at this point and at this point? What's happening? Even here, what's happening? Weakness is coming in. Well, how do we know that? Just supply is coming in earlier, right? But we're not reaching all the way up to the demand, the supply line, right? We would expect, the theory, so to speak, would say to us that this market should rally up to here, and then up to here, and then up to here, right? As we go along. But it's not reaching that. So we can because it's not reaching it, we can start to draw the conclusion that either supply is coming in earlier or demand is tiring out. Either or both indicate the potential for at least a pullback and potentially a change in trend. Okay? So one way that we highlight this is with the reverse use of trend lines. As I said, we always start here with the demand line in an uptrend. Well, now we draw in across the tops here. We would draw it in from this point and this point, the two significant highs here where supply is coming in, we draw in what's called a reverse use of trend line. And that will frequently show us how price is being contained. And when it's occurring after a trend is taken off like this, after it's taken off like this, it's showing us that either demand is tiring or supply is coming in earlier than anticipated. Okay, demand is tiring earlier than anticipated, or supply is coming in earlier than anticipated. Sometimes, this is not necessarily a good example of it, but sometimes we don't really have good demand points coming in, so we can early in a trend we might take and draw a reverse use of trend line as a supply line first, take a parallel of that, and it doesn't really work here, but I'm trying to show you as an illustration, take a parallel of that, and then it would be a reverse use of trend line for the demand line. So you can also do that. I tend to notice them most like this, okay, towards the end of a trend, or sometimes on an intraday chart early on in a trend. Here's an example on this is a daily chart, but you see this all the time on an intraday. And I'll just use this as a highlighter. We've got a downtrend going on. We'd start it at this point and at this point. This is where supply clearly came in and drove the market down. Market rallies back up, supply comes in, drives the market down. So we would draw our trend line, our supply line off of this, and we would put a parallel here. But notice what happens. We're not getting all the way down. So here demand is either coming in more early than expected, or supply is just not as strong as it was down here, and supply is weakening now. And so we would draw in this reverse use of trend lines to show that this is a term we're going to use next week, but the thrust coming down is shortening. Okay. This indicates that there is going to be a trend change, or at least a good pullback, a likely tradable pullback. Sometimes we don't even get a chance to really, if we drew a supply line in here and drew that parallel, that's what it would look like. And so we can use a reverse use of trend line, and forget this stuff here, but a reverse use of trend line, and that indicates that the supply is just not as strong, or demand is strengthening down here. And this is just a 5-minute chart on the S&Ps. All right, any questions on the reverse use of trend lines? Do we add a parallel to the reverse use of trend lines? You can. So for example, on this chart, I wouldn't do it on this chart, but just to show you, yeah, you can put that parallel in, and it would contain the price, but that's not what the chart is telling you here. What the chart is, what you really want to do in this case, Walter, and in most cases, in fact, is you want to look where supply comes in here and supply comes in here. So we draw that trend line in, and we draw that parallel, and we see that demand is coming in earlier here, or supply is just not pushing it down to where it's expected. So there's a potential change in trend about to occur, and we want to look to be buyers rather than sellers. If we did this and then ran a parallel off of that, we wouldn't see it. That's why we almost always want to use the convention, use the rule that we draw the supply line first on a down move, and the demand line first on an up move. Otherwise, it's liable to get us in trouble, and this chart is actually a good example of that. Not that it's going to get us in trouble, but we're not going to see the real structure of the market. Okay? Make sense? Did I understand? Did I explain that? Okay, yeah, okay, you got that. Good, thanks. All right. Now here we have a support point at E, and we have a reverse use of trend line showing demand coming in early, and then the market dips down at F and starts to rally up again. So this would be a nice, we're going to talk about confluence in a moment, but this would be a nice little trade, even though it didn't pan out in any spectacular way. You know, it should rally right up from here. It didn't do that, but that's okay. Not every trade works out, but this would have been the proper thing to do, would be to buy this area in here. Okay, we'll talk about entries and all of that as we go on, but I just want to give you the sense of what this is all about. Okay, so here, confluence, where we have more than one trend line occurring in the same area. This is very powerful, and we'll see some examples of this. We've got an up move coming in here from this point up to this point, so we would draw in our demand line. We would draw it in first maybe here, and then finally we'd get it adjusted properly so it's here. But we draw our demand line in, BB, and that's a nice respected level here. And I'm gonna show you another trick about this in a minute. We would draw our parallel CC, but we would notice that, gee, either demand's tiring out or supply is coming in earlier here, and so there's some weakness coming in. But we can use a reverse use of trend line off of this point and this point, and the market respects that very nicely up here. And also we have a resistance level, and we can draw a horizontal line across. And now we have three things going on here. We have the market hitting resistance, the market hitting the reverse use of trend line, and also we have weakness as highlighted by the reverse use of trend line because the market's not coming up all the way to the supply line off of our standard or normal use of trend lines, right? So resistance number one, hitting the reverse use of trend line is number two, and understanding that supply is coming in or demand is tiring out by not coming all the way up to the parallel is number three. And that's a really good story that we're constructing here, a good Wyckoff type story of supply and resistance, and the odds favor that market is likely to go down rather than continue to go up. So we want to place a short trade in here, right in this area, right in here, anywhere in here, okay? And that's why we think about market structure, and that's why we think about that's why we use simple trend lines to highlight the market structure, because we want a context. Every trade decision is contextual, and we want a strong context of either weakness or strength before we place a trade. And this is what we're looking for. Okay? Questions come in. If demand tires out or supply comes in early, the results are the same. Do we need to know which is true with demand or supply? I'll show you that as we go along, but in truth, no, not really. It helps to know if supply is really coming in here, and it was. You can tell that by the price bars. We'll get into that. But supply is coming in here, and that suggests that sellers are going to be more aggressive taking that down. They're going to do their best to really press this down. If demand is just tiring, it could just go sideways. Doesn't mean that we don't take the trade necessarily, but it probably won't produce as much of a trade when it's only demand tiring out as it will when there's clear evidence of supply coming in, unless, as we start going down, supply begins to really show its hand. Okay? All right. Hope that market structure is providing tells for the trader who can read the signs. Absolutely, Kevin. Absolutely. I always say we want to lean against market structure when we make our trades. So look at this. You know, here we made line BB. This is kind of an erratic chart a little bit, but we make line BB off of these 2 points, and now we come to this point here, right? We can also draw a little parallel line like this in here, trend line, trend channel, a downtrend channel, a minor one, and we can also do a horizontal here, right? So we have a longer term, more significant uptrend, and we're hitting the touch point on the demand line. We have a minor downtrend or downtrend channel, and we are at the point where we're oversold in that trend channel. And we have a horizontal support level where we've dipped under and we've now come back up and respected. It's called a spring. We'll detail that later on. That's like a no-brainer. That's a gimme trade. There's no reason not to buy that. Okay? No reason not to buy that. And the nice thing about using structure is a lot of times it will tell you where to buy, or at least the nearby location as to where to execute the trade. Sometimes with trading signals you're getting in, from indicators you're getting in early or late. I don't know, for example, where Linda Ratchke's 20-period EMA is. Is it coming in on this price bar here, or is it coming in a little higher, or is it a little bit lower and we're going to miss it? What's the ADX saying at that point? I don't know. But this is clear cut. I can see this, right? I know what's happening here, and I can make that trade. Same thing up here. Same thing right up here. We know what's happening. So now, the point that I'm trying to do to convey to you on these last 2 examples, this example here where we went through 1, 2, 3, and this example here where the touch point is number 1, the being oversold in the minor downtrend channel is number 2, and then springing off of the horizontal support is number 3. You see what I'm doing here is I'm stacking the odds up in my favor by using elements of market structure, components of market structure. We call it, this is David Weiss's term, he says you have to construct a story, you have to tell a story. Well, we're in the uptrend and we're coming into the demand line, and we're also in a minor down move and we're oversold, also coming into the demand line, right? Because we're oversold in the trend channel. This is the demand line down here of the trend channel. So we expect demand to come in both places. And then we dipped under horizontal support, found no supply under there. It didn't continue down, and it popped back up above support, so support holds on the horizontal. So those are three components of a story that add up to a good trade. That add up to a good trade. This is how we trade in Wyckoff, okay? By putting as much of the market structure behind our trade as possible. And I'll talk about triggers and key reversal bars and other stuff, and also how to read this as the price is coming down, volume's not doing much. You'll be able to see a whole lot more in a few weeks than just what we're talking about here in this area here. But this is the heart and soul of it all, is being able to identify those critical areas on the chart. I should find this quote, but Wyckoff said there are critical points in every market, on every chart, where a feather's weight will tip the scales one way or the other. And a skilled trader, and the trader who's skilled at reading this, has little to lose and much to gain. And this is exactly what he's talking about. This is exactly what he's talking about. And this is context. This is contextual decision making leaning against market structure. Hope that's clear. I want that to be as clear as a bell for you guys because it's so important. Do I do the small trend lines as a rule in my own trading? Sure. I put in trend lines all the time. All the time. Lars, you should see my charts. They're a mess. It was, you know, it was just the downtrend here, the little trend channel and the horizontal here. Chris says at the top of that down move there is a horizontal resistance also on the top of that down move. On the top of that down move. Here you mean no, not there. Or do I know? I'm not sure what that means. There's horizontal resistance. You mean here? No, higher. Oh, higher. Up here. No, higher. Here. There's a little bit of resistance here. Okay, yeah. Yeah, there is. But I'm looking for, and it could die out here. And you know, you're in the heat of a trade. You might take the trade off here. But, Chris, I wouldn't be going short here or here. Only up here where there's more of a story. There's not enough of a story in here. There's not enough components in there. Okay? Oh, wrong place. All right, let's start again. Let's get this correct. There's horizontal resistance. So, give me, is it like, not here. This is too high. Go below the first A. The first A, right in here. On the left, okay, that would be D and C. Somewhere between C and A, right? Okay. And so is it to the right or left of D? We'll get it. I moved too fast. Yeah, I know, I'm quick. It's to the left. Okay, so I've got resistance here. I'll go slower. Below C. Below C. Here. Left. Here. Below C but higher at the parallel line. Below C but higher. Oh, I'm sorry, I'm having a trouble here. Oh, I'll bet you're talking about here. The dotted line. Chris, let me ask you to do this. Why don't you mark up this chart and send it in, and then we'll because we're just kind of spinning wheels here. We'll definitely do it next week. Okay, we'll definitely do it next week. If you just take a snapshot of it and mark it and show me what you meant, we will. That'll be the first thing on the agenda next week because I do want to answer the question, but we're not able. Okay, all right, good. All right, so. That's confluence and that's constructing a story. Let's just take a look at confluence on a little bit of a different kind of chart. Here we are in a trading range, right? Remember we talked about that trading range to begin with, and and that it can be, you know, accumulation, because look at how we come into this trading range. We got a good move up. We're holding gains in here, and then we drive up through. So we have a high, a higher low, and a higher high, right? That's our definition of an uptrend. So what do we do with that? Well, we want to put in a demand line, don't we? We want to put in a demand line off of where the demand came in, and that's here at A, and then at B, parallel. Okay, and we draw that line up. Notice that we're touching it here, up in this area, but notice what else is going on. We've got that horizontal support line, and we've got confluence there. And you can see that the market dips down once and twice, and it's a perfect spot to go long here. This is a 30-minute S&P chart, and you could see this on a 30-minute chart, and you can be buying it quicker, closer into. This is probably about 1273 or 1274, and it's a 10-point move in the S&Ps. It's a nice one. It's a nice one into the end of the day. S&Ps typically, if they're going to trend, they're going to trend into the afternoon, and lots of times they'll go into the close. And here's a good story. We've got market structure is saying higher highs and higher lows on a nice time frame here. We come back to the touch point. We have a support level here, and we're off to the races. Okay, from market structure, here's a question from Lars. You have mentioned 3 points 2 times as a good story. Could you say as an estimate if this is something that repeats? Like, do you know if 3 points should be a minimum? No, Lars, wouldn't want to say that. I mean, you can do other things too. For example, on this chart, we had a gap opening here, and so we have a lot of imbalance between supply and demand, and we've held our gains. This is absorption in here. We have not, we've held in a pretty tight range for this time frame after gapping open and a higher high. I mean, I can put a lot of things in here, in other words. It's not just limited to 3. It's making a story to the point where you're comfortable enough with it. That's more important than the number. Let's see if I can explain this in a different way. We all like rule sets. We all like little checklists: A, B, C, D, and E, right? And if we can check off, and when we're beginners, this is a good thing to do, to have a checklist so that we check off, right? But when we're rule bound, this is being rule bound, right? We have 1, 2, 3, 4, 5 rules here, and they all have to work, and then we can take a trade. So there's 5 rules. But if we're looking at those rules as hard and fast, how can I explain this? It's good to have rules like this and a checklist when you're first starting out, to learn this. No question about it. It's the best way to do it. As time goes on, however, you want to get away from the rules per se and not say, I've got to have all of these, and if I don't have them, I can't take the trade. And you want to, when you have more experience, you want to be able to put together enough of a combination, and it's going to vary by context. If we're in a screaming, strong uptrend, and we just get a little bit of a pullback and a key reversal, that may be enough to take a trade. Just one little thing there, We don't have to limit it to a number or be bound by a number. But eventually that'll be the case. All right? I hope that's clear. Yeah, okay, you're laughing a little bit, so it is clear. Good. Okay. All right, so any question on confluence and putting together, leaning against market structure and using the structure as context? We've covered a lot of ground here tonight. We've talked about how important horizontal support and resistance levels are. We've talked about how after we've had resistance, at that same level will become support if it comes back down, if it's driven up through and comes back down. Same thing with resistance. If it's driven, or same thing with support, I should say. If we've had support in the market and we drive down through this support level here, and then it comes back up, this is a short trade in here. This is a good place for a short trade. Okay, and then we expect it to come down for a new leg. So it's the same thing. Support becomes resistance, and resistance becomes, this didn't quite come all the way down, but you get the idea here, it becomes support. So we talked about that quite a bit. We talked about access lines, where the market will trade, where the same line will be support, and then resistance, and then support again, where the market will tend to rotate around. And knowing those levels and knowing what to look for, these are the hardest things to see in horizontal support, in horizontal trend lines. The access lines are the hardest things to see, but they can be the most valuable things. Okay, I'll bet you never knew there was this much about horizontal support and resistance. Then we talked about diagonal lines, how to draw a proper demand line, how to draw a proper supply line. Unlike the horizontal support and resistance, we have to adjust, we frequently have to adjust our diagonal demand and supply lines. When we start to see a higher high and a higher low, we draw that demand line first, 90% of the time. We want to we will draw that demand line first. We draw the supply line as a parallel off of the demand line where supply comes in, and that would be right here. Okay. When we're in a downtrend, we draw the supply line first. It's just the reverse of the demand line. And then we draw the parallel of the demand line. When we start to see that if we're in an uptrend and demand is tiring, or it seems to be that supply is coming in earlier than we expect it to, and we expect it to come in at the supply line. When it's coming in early, then we use a reverse use of trend lines. And we can do that either in an uptrend or a downtrend. On rare occasions, when we can't get a clean, when it's clear that we're making higher highs and higher lows, but we don't get a clean couple of areas where demand has come in, we can try to use a reverse use of trend line at the beginning of a trend, but it's more risky because we don't know if it's going to hold or not. Okay, when we're in an uptrend, it's demand that is in control, and therefore we draw the demand line first. When we draw the reverse use of trend line, we're drawing a supply line in an uptrend, and that's riskier to do. It's going to be, the odds are higher that it's going to be less accurate. At the end, after the trend's been going on for a while, however, the reverse use of trend lines are terrific. Okay? All right, and then we talked about confluence, where we can have more than one trend line, where price interacts with more than one trend line, and that is the beginning of building a story or constructing structural elements, combining structural elements into a trade setup that is of high value and high variance, where we can really take a good trade and be confident that it's gonna most of the time work out for us. Okay, because we're leaning against structure. We also talked about the contextual approach to trading here, where all decisions are contextual. And I said, and you can try to prove this out if you want, if you just take every trade setup, take your plain vanilla trade setup, if you take every one that comes along, at best and you ignore structure, at best you're going to be a break-even trader after 100 trades or so. You start putting structure behind it, after 100 trades you're going to be a good trader, a really sound trader. And so that's why we started with this, and we're going to continue to talk about structure for the next few weeks. All right, any questions on what we've covered? We have covered quite a bit. There's a lot to digest. And Helen will process the recording. Usually she does it in a couple of days. Usually it takes her 2 days to do because there is some time needed to process, and then she'll put it up on the website. All right, here's a suggested assignment. And again, the more you do this, the better off you're going to be. Start becoming familiar with structure and trend lines. I've got 2 exercise charts that follow here. Draw trend lines on the 2 charts. That's part 1. And then part 2, this I think I'm using the British pound on these charts. So whatever market and time frame you trade, send some charts in that show trend lines that highlight demand lines, supply lines, horizontal support and resistance, where support becomes resistance or resistance becomes support, access lines, and the all-important confluence lines. Okay? The recording should be done, what's today, Wednesday? She should definitely by Friday, yeah, hopefully. So here's exercise chart number 1. Draw in trend lines here and see how, and don't just draw them in, be mindful about it. And start looking at where the trend lines are interacting and where price is interacting with those trend lines, okay? And that, wait a minute. Well, that was dumb. I put the same chart on 1 and chart 2. Okay, there's a second half of British Petroleum. So I will send that out to you tonight in a PDF file, so you've got the both charts. I'm sorry, I must have been half asleep when I did that. That was mindless. Yeah, the 2 charts are the same. So I will send out the correct charts for you tonight. And that's it. Any questions on what we covered here tonight or anything else? Boy, I did this in just an hour and a half. That's pretty good. Would I show as one of my charts that's all marked up? Yes, I will, Kevin. I will. What I'm gonna show you is how I do my charts each night, and we're going to talk about how to do that. Lars said, should we send in one we choose ourselves as mandatory? It's suggested. And I would think, you would want to do that, but some people don't, and that's okay too. But if you want to, please do. 2+ hours. Oh, did I really go 2 hours? I'm sorry, Chris. I guess I did, didn't I? Yeah. Okay. Glad you liked the presentation, Chris. Thanks. I heard a few times we need to observe how price behaves near the important levels. Can you elaborate on that? Yes, Hans, I will. You will see all of that when we talk about strength and weakness, signs of strength and weakness. We'll cover it. Don't worry. I can only cover a little bit as it was 2 hours on trend lines. That's quite a bit, right? So you now know pretty much everything that I know about trend lines. In fact, you know everything that I know on trend lines. There's really not much else that I can tell you about them. But it does take a couple of hours to do. All right, thanks everybody. Any questions you have that you come across, just drop an email. We'll be happy to answer them. And try to do the assignment and send it in, and I will look forward to seeing you all next week. All right? And Kevin says here, one last comment. I'm excited about learning about market structure. Good, I'm glad. I'm glad that's the case, because this is the key. In my experience, and most professional traders I know, their experience, this is the key. All right, everybody, have a great week. Good trading, and I'll trade mindfully, and I'll